Hi guys, this week we're doing the Chapter 15 tax return assignment. I decided not to have us do it in Tax Act because of some snags I ran into with it. And like I said, 1120 corporate returns are very complicated and they're not even used very often anymore. So we're going to do one each of the tax return problems at the back of Chapter 15. Tax return problem 1, which is 1120S, and tax return problem 2, which is the 1120 in Connect. And I'm going to be going over these in this video, and the settings are going to be a bit different. I've done it so that it doesn't show you the solution at all. You can watch this video for the explanation and solution, and you get unlimited tries, and you just edit your submission until it's correct. So you can't really go wrong. You'll get the points if you put in the time. So first of all, they do this simpler return first, the 1120S. The real difference here is that with the second problem that we're doing is that is an 1120 corporate return. And so with the corporate return, the corporation is paying tax. It has income, expenses, and then it pays taxes. With the 1120S, the front page looks very similar to the 1120 and to our partnership return. If you remember income, expense categories, we'll go over a few of the differences in this video. But the 1120S is a combination, really, of the 1120 and the partnership return. So we'll be going over that as we go through this return. Tax return problem 1 is very small. You can see it here. You may want to refer back to the 1120S description, the last page in the chapter. Essentially what the 1120S is doing is it allows the corporate structure to be taxed more similarly to a partnership for smaller businesses. So to be an S Corp, you cannot have more than 100 members. None of them can be foreign, and there are a few other requirements. On the other hand, as an 1120S business for taxes, remember that's only a tax distinction, right? The concept is they're still a corporation legally, but for taxes, they're 1120S. And so it's really for those smaller corporations. On the other hand, the big corporations get or any 1120 corporation for taxes, they get the dividends received deduction, but the S corporation does not get that because it is flowing through and not really paying tax at the corporate level, although there are some reasons when that would happen. Now, one thing that the book doesn't even talk about at all is that primarily people electing S Corp status are actually LLC businesses these days. It's very common for an LLC business. They would be default to tax as a partnership. And then once they're making a decent amount of money, it can be better off for them to do the S corporation. However, because we've had this tax law change for the qualified business income deduction, that throws a wrench in that kind of status quo, standard quo. And the reason a smaller business shouldn't form the S Corp is because the owners become employees in a corporation. And that applies to the S Corp, that applies to the 1120. Remember, in the partnership, owners were not paid as employees. They could just take money in and out, and then it's all reflected on their Schedule K-1. Here, it's going to be different. The owners are employees just like anyone who works in the business. Okay, so with this first problem, we can see they have business income, interest income, dividend income, which is qualified, which means it's qualified for the preferential rates. We have, let's get my pointer, long-term capital gains. So what does that mean? They sold capital gain property, not business property, right? They sold capital gain property, which means something that they held for personal use, which doesn't apply to an S Corp. And so it must be investment use. So commonly that would be a building that the company is using, right? And if they're not in the business of building buildings and buying, selling buildings, then that holding that building is seen as an investment purpose. So when they sell that, capital gain results from when you sell capital assets. So all of their income here. And then expenses, non-officer. So this means anyone working in the business, like regular employees, salaries and wages, owners and officers. That is our Phil and Liz here at 60 and 40% ownership in WJ Corporation and S Corp for taxes. Okay, so then we have depreciation, which includes Section 179. We'll talk more about that. Interest expense, taxes and licenses, meals and entertainment, which says 100%. We'll talk more about that because that's deceiving, because they are actually going to treat it like 50% in this problem. Usually 100% does mean you could deduct 100% because it's actually related to business operations. But in this case, they apply the 50% rule. So I wanted to give you a heads up about that, but we'll look at it in a moment. Auto, so this is going to be not vehicles that the owner, like a personal vehicle. In this type of corporate situation, none of that would be deducted. Just like if you have a job at a corporation working as an employee, you don't get to deduct your personal vehicle. So neither in this case, even though it's a small business, and that's why you want to stay self-employed if you're self-employed using your personal vehicle. This would be an auto actually owned by the company and only used for the company. Or if it is used for personal purposes, then the workers who are using it should be paying the company for their personal use. Insurance, non-officer health. So that's health insurance for these people, the non-officer employees. Accounting and legal. So those are like professional fees. Repairs and maintenance. You recall that category in every return. Charitable contributions right here. So in an S Corp, just like in a partnership, and for many of these items, charitable contributions are going to flow through. Remember, with the corporation, they can contribute up to 10% of their income to charitable contributions, but the individual can actually contribute up to 50% of their income. So it's going to be treated differently because it's going to flow through to our owners here. Payroll penalties. Now, if you recall, business expenses are deducted, not ever penalties. Okay. Total expenses, which is this total, right? These could be their accounting numbers. And then we have our net income. So heading down, we've learned that they get a distribution of $20,000 to its shareholders. Now, they didn't tell us how much each person received. You know why? It doesn't matter. They are even if one person took 20,000, they are taxed according to their ownership percentages. So we're going to complete page 1, which is exactly like the 1120 form that you'll do in the next assignment. And then we'll see Schedule K, which is very similar to the partnership, and Schedule M1, which also was similar to the partnership form. So we weren't given a lot of information. You just are using the information you were given. Enter the name. Get started with our gross receipts. That's straightforward. We're not going to enter any of the other income amounts here because these are going to flow through and be addressed at the owner personal level. Only our actual business related activity. Remember, we said this was investment related. Same with dividends, same with interest, some sort of investment. So remember this first line, our first expense was guaranteed payments for partnerships. It's now compensation of officers, wages and salaries for the owners. Then we have wages and salaries for our regular employees. We just went over that. Repairs and maintenance, taxes and licenses, $15,548. You can see that very straightforward. Interest, $5,220. That's also straightforward. And then we have depreciation, line 14, $32,888. Depreciation expense. So how did they get that number? I bet you can tell just by looking here, right? They're going to take the total depreciation and they're going to minus out section 179 because that was a deduction that is going to be reported for taxes at the owner level based on their ownership percentages, because that's an accelerated deduction that will pass through. So then everything else that is allowed as a deduction will go under other deductions. And that includes every other amount with the exception of our 50% of meals and entertainment and our fines and penalties. On to page 2. So this is our ordinary business income from line 21. Right down here, just like for the partnership, if you recall. The partnership, in a way, was a bit more complicated. These amounts are going to be a little more straightforward. Our interest income, our dividend income, which they don't have it under qualified here. So keep that in mind. Just follow what they did. I believe that's a mistake. Net long-term capital gain. Our section 179 expense that we took out of depreciation. Our charitable contributions. And then down here, we have non-deductible expenses. So what were the expenses that we just didn't deduct on the last page? Right? What were those expenses that we just didn't deduct on the last page? Well, we took 50% of meals and entertainment, right? Plus our penalties. That is the amount that is a non-deductible expense that goes here. Okay, otherwise I think all those numbers should make sense. Continue on. Combine the amounts on line 1 through 10. So this is just a subtotal that should subtotal up for you. It's a check number, which is going to check to here based on our non-deductible expenses to get to, let's see. So this is just like the M1 section that we did in the partnership return, and you can see Schedule M3 required instead of M1 if total assets are more than 10 million. Much higher threshold than the partnership for the additional requirements. And that's all, pages 1 through 4. So this is not too long of a problem. I'm going to end this video here, and there'll be another video for the corporate.